Welcome to the Essentials of Financial Statement Analysis, where we uncover how to make sense of complex business data. Here, we'll explore 7 core objectives, from using cause of change analysis and common-size statements to highlight patterns, to understanding how competitive forces and business strategies shape profitability. We'll break down key metrics like return on assets and return on common equity, distinguish between short-term liquidity and long-term solvency risks, leverage cash flow statements for credit assessments, and ultimately, learn how to interpret profitability and risk results. Let's begin our journey. Why do analysts rely so heavily on financial statements? These documents allow us to peer into a company's economic reality, its operations, condition, and future potential. But it's important to remember that financial statements are not flawless mirrors. Sometimes they can miss important details or fail to provide a completely faithful picture of a company's true health. Recognizing both the power and the limitations of these statements is essential for anyone aiming to make informed business decisions. Conflicts of interest. Why do they matter so much in financial reporting? When management's goals differ from those of lenders or investors, the quality of financial reports can be at risk. Imagine a scenario where managers benefit from presenting a rosier picture than reality. This misalignment can mislead stakeholders. That's why companies are required to disclose any transactions involving potential conflicts. Transparency helps safeguard the integrity of financial information and builds trust among all parties. How do analysts quickly spot shifts in a company's cost structure or profit margins? They turn to common-size statements. By expressing each income statement item as a percentage of sales, analysts can see how much of every sales dollar goes toward operating expenses versus profit. Similarly, recasting balance sheet items as percentages of total assets reveals shifts in resource allocation over time. These tools make it easier to compare companies or track performance trends, regardless of size. What drives superior business performance? 2 key strategies stand out: product and service differentiation, and low-cost leadership. Differentiation means offering unique products or services that inspire brand loyalty and command premium prices. Think about why people pay more for exclusive brands. On the other hand, low-cost leadership is all about operational efficiency, allowing companies to underprice competitors while still turning a profit. Both approaches can be tailored in various ways to suit a company's strengths. Let's recap. Financial ratios, common-size statements, and trend statements are vital tools for tracking company performance, comparing peers, and checking compliance with benchmarks. But did you know there isn't always one right way to calculate these ratios? Analysts often tweak their methods, sometimes based on personal preference or industry standards, other times to improve comparability across firms or periods. Understanding this flexibility is key to making sound financial judgments.